It is 4 o'clock on this lovely Wednesday in July. Welcome to the GRWP Investment Committee. I'm Bobby Mascia. I have the rest of the investment committee here with me, Jordan Kaufman, Sean Cole, Brandon Sisk, as well as our guests today, Jacob Koenig and Ross Joel. They're going to spend some time with us after we go through some of the market recap. So to go over the M&A world and how they work with clients who are gearing up or thinking about selling their business, or even just give some tidbits along those lines. So, Sean, you wanna start it off for us?
Yep, sounds good, Bobby. I appreciate it. So first thing we want to do is just give you a review of the market vitals so far in 2024. I don't think anyone expected that the S&P 500 would be up 19% halfway through the year after a 2023 that saw the S&P up over 20%. So just extreme strength in the market so far over the last 2 years. And as you can see in the last month, it hasn't stopped, up about 4% in that last month. And we've seen some really interesting things in the market over the last month, especially. One thing that really sticks out to us, the Russell 2000, which is an index tracking small cap companies, up about 11% year to date. If we look back to last month's webinar, that number was about 0. So really just in the last few days since that last inflation print, which came in at 3%, small cap companies have rallied extremely hard to get up to that 11% number year to date. And like I said, it's really just been the last few days led by that inflation print coming in at 3% last Thursday. Another thing to point out, that 10-year treasury rate over the last month, it has fallen slightly. And that is because of the same exact reason, because inflation coming in at 3%, expectations are that interest rates are going to start getting cut later in this year. September is the soonest that's expected. So that's something that we are going to be looking out for as we continue to analyze this market and observe the things that are going on. Brandon, what are you seeing so far in terms of growth versus value in 2024 and the different sizes of companies, how that's affected performance?
Yeah, I think this was something interesting that I found and was looking at. I think for a while now, we've kind of all heard the difference between growth and value, and will, value kind of catch up? And similarly with that, where are the small cap companies and even some of the mid cap companies? How are they going to try and catch up to, the really large companies that we've all been seeing, especially, the leaders in the S&P 500? So even just, a quick takeaway from this table is really, if you just look at the S&P 500 growth versus value, you can see a 20% difference in, performance just in that. And then, an even more disparity if you look at the S&P 500 growth versus, the S&P small cap 600 value, which is only up about 3% this year. And, really just taking note of, one, the outperformance. And then I think it's also something to continue to observe in the future, is if anything really, bucks the current trend that's been going on for, this past year, and even what we've kind of seen in 2023.
Yeah, I think definitely taking note of that small cap move that we've seen over the last few days. Yeah. Is that a trend that's starting to emerge? Is that something that's going to continue through the later months of 2024? That's something that we really have on our radar as we're looking to allocate accounts and be positioned properly.
Sean and Brandon, just looking at this, and I think you guys absolutely nailed kind of the key themes, the key points that you'd want to highlight 6 months in, and what's driving the train here. 2 questions. Does it make sense to you that this is what we're seeing now? Obviously, nobody could have predicted it, but hindsight 2020, we can kind of look at this and be like, yeah, that makes sense, or doesn't. And how many people do you think would agree with the perspective that it makes sense? Like, you might think it makes sense, but do you think that's a popular view, or do you think that's an unpopular view?
Yeah, that's a great question. I think coming into 2024, that was the big pick by Wall Street. Small caps are going to catch up. Last year was the Mag 7 that carried the market. The other 493 companies are going to show up finally this year. So I think they've been making that call since January, and it's just taken a little bit for that to actually happen within the market. And it's been based off inflation and interest rates, in my opinion. I think inflation hitting that 3% mark is good momentum on that inflation number coming down, and low inflation, low interest rates really benefits those small cap companies that don't have those strong balance sheets. They need to rely on leveraging, borrowing money at those interest rates. So seeing those numbers come down is what really, I think, has led to this small cap boom we've seen over the last week. But it'll be interesting to see if it continues throughout the rest of the year.
So question to Jordan. Jordan, as you look at the dynamics of the market, how do you see that how do you see the whole election year playing through? Do you think that this is all economic data? Do you think that there's any assumptions baked in here? When you look at where we've been over the past 6 months, we always talk about being more observant than we are predictors. So I'm not asking you to predict, but rather, kind of sum up some of the market chatter and in terms of the market.
Yeah, I think that, for market professionals, they're probably not as election centric as the typical pedestrian, let's call it, that's walking down the street or chatting in the bar. Really what's been driving this whole train, I think, is 100% the story of AI, the fear of missing the next technological boom, the perceived increasing safety and predictability of large cap companies that just continue to shatter expectations, grow faster than trillion-dollar companies should be growing. And pretty much, the question mark, like, why do I need to search through the entire market to find these things hiding under rocks when I can just jump on the coattails of these massive titans that seem to be escorting us into this big future? So that's something I think that really is the big story, is just the AI, and the election's kind of an afterthought. I think it's starting to get into the conversation, but it's just finding its way into the conversation to make people more excited. I think people are starting to turn a little bit of a positive eye towards what might happen in this election and how it can benefit the street, or at least that's starting to happen on the professional level. So we'll have to see. Sorry, Ed.
Oh, I was just going to say, and probably the biggest thing being the sunsetting of the tax provisions next year. And, are they going to be extended, or are we going to be reverting back? And, I think that also weighs into where we are from a political landscape and decisions that are pending in the future. So.
Yeah, I think sometimes also people give Wall Street a lot of credit for being very thoughtful and thinking through all the nuances. And I think sometimes actually is kind of the opposite. They take a simple idea and they just come up with ways to defend it in a positive way. So, if you want to be positive about an election year, you want to find reasons to be positive, you'll find the reasons to be positive. And if you want to be negative and the trend was down, then everyone will be sitting here talking about why things are going down. And it's clearly because things are going to get worse. So the trend itself sometimes can create the story.
Nah, you're not a bear. We're never talking about bear markets.
Well, it's not us. I'm talking about us. Talking about everyone else. We're always,
Not you, it's me.
we're always on time. Come on.
Somebody.
Let's move to the next tidbit of information here.
Yeah, so we wanted to jump into some interesting news stories that we've seen recently. We think this first one is definitely relevant with our friends from Woodbridge here, just looking at some mergers and acquisitions that we've seen in the market recently. One of them being the Saks is looking to buy Neiman Marcus. So $2.6 billion merger happening. And this just really points to aging industries looking to consolidate over time. So if you think of Neiman Marcus, Saks, these big department stores, we don't expect there to be more department stores over the next 5 years. These companies are going to have to start looking to come together to cut costs, remain profitable. And so we're seeing a lot of mergers and acquisition activity around some of these aging industries. Another example, Paramount and Skydance, two film companies, are merging. And that's because streaming companies are taking over a lot of the movie production. So you look at Netflix and how many Netflix original movies are coming out. Amazon Prime, all these streaming companies are really taking over that side of things. So these older film companies like Paramount, Skydance, MGM have to kind of look to each other to join forces, cut costs, and remain relevant in the space. And Amazon and Salesforce are also investing into this merger. So everyone's kind of getting their hands in here to try to find some profit as these companies are merging. Just something that we thought was interesting.
Yeah, and I think the other thing that is how these industries change, and industries seem to be changing pretty quickly. Obviously, COVID, hit the accelerator button too. But there's a lot of different reasons why M&A is going to happen. Sometimes it's people want to, buy their next form of growth. Sometimes you're going to see people just finding ways to deal with their own industry cannibalization. There's a ton of reasons. We'll let the Woodbridge guys, who are the real experts, kind of dive into this. But we definitely wanted to highlight that for a long time, a lot of M&A was blamed on low interest rates, or not blamed, but some questionable deals were. It was kind of like, well, the only reason they did that was low interest rates. Interest rates are not low right now for a lot of these deals, so companies and investors are still finding reasons to do it, and it's always relevant. And there's some other big players in there that we'll talk a little bit about down the slides, but something to keep an eye on. And I think, it went quiet for a little bit after 2022, and it seems like it might be picking up again. Let's talk about our good friends at Boeing, as we just booked some plane tickets today.
Yeah, well, I mean, with Boeing, we recently saw them obviously having been pled guilty to the criminal fraud case. And I really think it kind of brings up 2 points about Boeing, and then also in general about other companies, is whether they're really almost too big to fail. And then also, how is that relationship really affected later on, either through the government and then also through like regulation or other antitrust laws. We've also seen Microsoft have to step down from the OpenAI board. And really, as we continue in, the next few years, is how do we really see these big and like really large companies kind of navigate those waters? And obviously, they can't just be picking up whatever company. There's, some regulation behind that. And how do they kind of tread lightly and still operate, but then, also still kind of do their own thing?
Well, even if you look at like this $243 million fine, so to speak, their revenue was what, 78 billion last year. So relatively speaking,
Yeah.
how much of impact is it really to their bottom line? Probably, what's that, about 3% and change. How many businesses are going out of business or even questioned of their validity after a 3% fine? So, when people look at that 243 and they're like, wow, 243 million. Yeah, they do $78 billion in revenue.
No, I think that's a good point, and that's also been the critique of some of the big fines that Apple received from the EU, and some of the other large tech companies. It's oh, they fine Apple 1.3 billion. Great, Apple makes it every 9 days. So yeah, it's definitely if regulation and antitrust wants to show it has teeth, then show your teeth, man. Otherwise, these big companies, they're becoming oligopolies, and they are becoming too big to fail. And we are almost having like small little government companies come up because of this. It's hard to say, because they say, trust us, we're doing the right thing for you. It's okay. And, that's something that, I think we've seen a couple of them maybe violate some of that trust at times. I don't want to get too far into it. I feel like this could be a whole Netflix series. So, but I think it's important to just keep some of these things in mind. M&A is happening. It's happening across all sectors, not just only the sexiest. And also, this whole threat of the Mag 7 and all these big companies that are running out and carrying the market higher, even as we're talking about small caps playing a bigger role in the previous slide. Really, it's been the big large cap companies that have carried us to this point. And if antitrust or continued scrutiny of some of their business practices goes forward, and they actually want to hurt these companies, it seems like there's room to do so if they decide to. So we'll just see what happens with that. I don't think it's going to happen personally, but
Well,
We
no, it's
don't
the
make
biggest.
predictions, we just observe here.
Yep.
Well, it's the biggest American manufacturer in the aeronautical space. So I don't.
Yeah, they're going to make it. It's just a question if it's with the same CEO, the same management team, the same board of directors, and under the same name.
Yep. It's really just Boeing and Airbus are the two big airplane manufacturers, and the government accounts for 40% of Boeing's revenue. So they're getting a big boost from what the government's buying from them. And it really just comes down to, is there going to be another company that steps up and is able to take some market share from them? Because they've kind of proven that they're not a very well-run company in the last decade, I would say.
Boeing's going to change its name to X Airways.
All right.
Yeah, so here we have a table of, the election year and then also how the S&P have done after different time frames. We actually had kind of a similar table a couple of webinars back where we did how the market would react after initial rate cuts from the Fed. And it does tell like a similar story almost. If you look after, 6 months or 12 months after, there's only two real negative years, which is both 2000 and 2008. And that's also, not necessarily because of the election. There was also, the dot-com bubble and then 2008 with the financial crisis as well. So really taking that into consideration of what was caused, these down years. And even if you look at it after, 6 months, the S&P is on average up 5%. And then after 1 year, it's up 16.4% on average. So I think it's something to really, look at and kind of observe how the market continues to trend throughout the end of the year and then the beginning of next year. And it's really just to kind of consider also, thinking logically as you're making observations about the market and not kind of reacting with your emotions.
Market loves closure.
Yep. All right.
I think it's self-explanatory. I don't know. Sean, you got any extra thoughts to add?
I think Brandon nailed it on the head. I think, yeah, once the election's over, just having that predictability and knowing what's going to happen and who's in office and having one unknown being taken off the table just leads to positive market returns.
Boom.
All right. What's in stock? Brandon, you want to start on this one?
Yeah. So here, this is an interesting chart that we found through Bloomberg. And it's just the number of mutual funds and ETFs versus the number of US stocks. Something to take note of is, there's about 3 times as many funds in the US as single stocks. Two of the reasons you can really come to from this are companies are staying private for longer. And then also having, mergers and acquisitions from either, bigger company buying up those smaller companies as they're getting started. So they're not able to go, public in that time. So it's kind of all funneling into the same direction. And then also the increase in funds. I think one of the things that we were talking about before, and that's important to take note of, is the institutional competitiveness, and then also their innovation. So, if you even just look at BlackRock or Vanguard creating a lot of funds, it's not necessarily them just creating a fund for the sake of it. It's, sometimes maybe they saw a fund that was gaining a lot of attraction and pull towards it. So, they wanted to create a similar strategy under their name, and they're trying to just continue the competitive process of, them growing their own assets and kind of having similar strategies. If Sean created something and I have one institution and he's the other, and we're both kind of looking at each other of what are we doing right, what are we doing wrong, and how do we kind of tailor to, the people that are investing in our funds. You can really see a large increase in funds over that time where, there may not be as many, companies going public versus a fund created.
I'd also look at the time frame here. We got 30 years. So you're looking at the dot-com period of time at the beginning of this chart. I'd also say right around, if you really look carefully at that funds chart, you kind of have a little bit of a plateau from 2000 to 2005. And there was a little bit of a recession during that time we just saw in the last table. In 2005, ETFs became a lot more popular, or right around that period. ETF distribution, I think investor confidence in ETFs really was on the rise there. And mutual funds don't go away when they make an ETF counterpart. They kind of stick around because they're in 401ks or something else. So it's always important to see kind of, assets per fund or assets on average, per fund. I guess it's all aggregate anyway, but the median assets and fund or something like that, because I don't think the number necessarily is always the best number to look at the number of funds out there versus the assets that funds have gathered versus, supply of dollars out there. There's a lot of ways to interpret it, but it was an interesting chart for sure. I mean, it definitely shows that things are changing over the last 30 years. And the question is, does that continue or do we see a shift?
Well, how me as an investor, how should I think about this? Why is this impactful to the people that are watching this webinar?
John, you want to take it?
I think it just shows the range of investment options that are available out there, especially in today's environment. The amount of funds that are available from different managers, different styles, different investment philosophies, both active and passive between mutual funds and ETFs. We really have a wide range of investment vehicles at our disposal, and it just shows kind of how the landscape has changed over the last 30 years, just with globalization of the markets, technology, innovation, more competition between these institutional companies that are creating these funds. It's just kind of.
Is it fair for me to say, with the amount of funds that are out there, it makes it just a lot more confusing, the landscape for individual investors to go out and find the right types of investments, or does it make it easier for people to find the right type of investments?
I would say harder. Yeah. With all the options that are out there, it can be easy to be confused. If you're a retail investor that's not used to kind of sifting through the information, doing your research on these funds, it can be a bit overwhelming, I would say, with all these options out there. And that's
like a Cheesecake Factory menu.
Exactly. They have everything under the sun, like a diner. It can take.
We're at the 422 mark. Let's what do we got coming up next?
Woodbridge International.
All right, guys, you ready?
We're ready.
For Jacob and for Ross to shine. All right, Woodbridge International. We met these guys. I was actually on Jacob's podcast, and he does a great job interviewing. I had a really fun time being on that podcast, which opened up a conversation in terms of the types of clients that we work with and the types of clients that we see coming across. And there just seems to be a lot of overlap in terms of how we think about things and how we have conversations around clients and approach issues and strategize, because this is one of the biggest transactions in a business owner's life, is getting ready to sell, where a liquidity event can happen in a number of different ways, and the opportunity to sell can also be thought of and happening in a number of different ways to a number of different prospective suitors. So these guys are here. They are a middle market M&A firm with 19 offices across North America. These guys just so happen to be in Connecticut. 30 years of business experience. These guys have seen it, the amount of business that they have coming through, and mostly through referrals, which is always the best sign of a strong business, is when internal referrals are a major part of their revenue. It's not having to source new business. It's because people are actually standing on the top of mountains and saying, you got to use these guys, or at least talk to these guys. So, the whole approach: get more buyers, get more bids, higher prices, and a better fit when selling their passion. So that this way, you're turning it over to the right people, and you're not just turning it over for the check at the end of the day. There's some continuity going on with the thing that you've built for years. So I'm going to kick it off to Jacob and to Ross, and let them take us through a little bit about how they think about the landscape of mergers and acquisitions for mid-sized companies.
Yeah, absolutely. So thank you for that, Bobby. And look, I think we've got this slide up here, sort of continuing on the theme of looking at the market from a top-down perspective, why it's such an exciting time for M&A, especially in the lower middle market. In 2023, last year, volume in M&A hit a decade low. Interest rates started rising. You had bank failures. There were a host of reasons why things slowed down. But at the same time, you're seeing private equity continuing to grow as an asset class in terms of the total amount of AUM being managed. And that undeployed capital, it needs to get out. If they don't use it, if they don't invest it, it is at risk of being recalled. So the combination of the low volume from last year, that backlog really built up, has made it a real seller's market this year. And so we are seeing some of our, some campaigns we're getting to market are getting 60+ bids. That's 200 to 400 books out. We had our record ever in terms of a campaign getting NDAs signed, SIMs into people's hands. So it is very much an exciting time, and something I think your audience would be keen to know about. So with that, we can dive in. If we could go to the next slide here.
Yep.
Yeah, I mean, look, a little bit more about sort of Woodbridge and how we're different from the market, because look, my father started the company 30 years ago, and he did not have a background in M&A, the traditional way of doing things, and that sort of outsider's approach has given us this unique perspective. A lot of our competitors, and frankly, the traditional way of doing things has been to look at the bulge bracket firms, the Goldman Sachs's, the Morgan Stanley's, how they operate. When you have a multi-billion-dollar company coming to market, there are only 5-10 companies in the world that can buy that company. And so it does matter 100%. Just who are your relationships? What are your ideas? Is there an opportunity? Are people looking at purchasing something right now? In the lower middle market space, companies that are going to sell for $5 to $20 million, there are literally hundreds of thousands of potential buyers. And so no one has a crystal ball. No one's going to be able to say, oh, I can just run through my Rolodex and figure out who's going to buy your company. That's just a false premise. So what we really focus on is marketing, is drawing out the best, the highest alpha. What are the points about your company that really make it unique, really stand out? We've got our creative director who comes out and brings those points out in a video that goes along with our sim, along with the teaser, along with everything else that we do to bring, again, to get out to a broad potential set of buyers, hitting more potential buyers. You never know which private equity groups are changing their strategy or which strategics are out there looking to get into a parallel business or expand horizontally or vertically. And so rather than trying to make assumptions, to go out there and put your best foot out and get them to come in and get an auction together, a competitive auction. That's what's going to drive the best possible value as you sell your company. So with that, I want to move on here and introduce Ross Joel. Ross was the co-founder and former CEO of Broadcast Med, which is one of the largest healthcare media platform companies in the US. And after starting Broadcast Med in '94, he sold to a private equity company in 2020. He remained CEO for 2.5 years. He helped to grow that company to $80 million in sales and 300 employees, overseeing 5 acquisitions in that time. And Ross, maybe we can start off here. You can tell us a little bit, share with the audience your background, what led to your decision to sell, and how you found Woodbridge after 2 failed processes with other banks.
Yeah, absolutely. Thanks for having me.
Ross,
Thanks for,
Can I just add a little value to this?
Yeah.
You don't know how difficult it is for somebody to sell their business and then spend 2 years to grow that business as no longer the business owner. So the perspective that Ross has it's really interesting, and I implore you to just take a listen to his experience, because it's phenomenal. He's a great guy, and he's got some great experience.
Thanks, Bobby. I appreciate that. Yeah, so I was a television news anchor for about 10 years, and I got sick of chasing fire trucks for a living. And my wife and I had our first of our kids, and we decided we didn't want to run around the country chasing the next bigger TV market. So I ended up meeting this guy, and we started what was a traditional video production company. We did a lot of corporate videos. We did not do wedding videos, I will say, but we did a lot of corporate videos. And we, because of being in the Northeast, we bumped into a lot of healthcare clients, and ultimately decided that we were going to go down the path of focusing on video production in healthcare. Well, the internet bubble is percolating about that time. And there's a guy named Mark Cuban who's got a thing called Real Video that he started. And it was really the forerunner of streaming video. And so I came up with this concept of doing a simulcast of a surgery via the internet. And it turned out it was the very first one ever done in the world. And we got a lot of press about this thing. We named it OR Live, Operating Room Live. And I was on the Today Show. I never could get on the Today Show as a news anchor, but I got on the Today Show as an interviewee. But you know, we got an incredible amount of PR, and you know, we had grown our revenue to about $4 or $5 million, and we decided, you know, let's see what we see. And so we hired a small boutique investment firm, and this is around 2004, 2005. And they were relationship driven, you know, decided they were going to take us to their relationships. And we ended up getting 2 bids, and we picked one, and we started early diligence with one of them. It was actually a public company, WebMD. And very early on in the diligence, you know, they realized what we, I guess, knew in our hearts. We were not prepared. I mean, our top line was small, you know, $4 million, which, you know, lower middle market, if your EBITDA is, you know, trending positively, ours was not. And so, you know, they looked at the financials and said, you know, hey guys, you know, you're just not ready for this. So we went back to the drawing board, and it was 5 years later. We refined the business a little bit. Top line was not a lot bigger. We were about 5 million, and decided to go back again. We hired a different boutique firm, somebody that was focused on the healthcare media business. And once again, they worked their relationships. We got 2 bids. We took one of them. We went through diligence, and it was supposed to be 3 months of diligence. It ended up taking 5 months. And this harkens back to Woodbridge's expression, time kills deals. Time killed this deal. We literally got to the morning of close, 5 months after diligence, you know, tens of thousands of dollars spent, emotional capital invested. The investment committee called and said they were going to walk away from the deal, and I was beaten. I put my tail between my legs, and I was done. But for the fact that my wife basically said, you know, suck it up, buddy, get out there, I'd still be whining to myself. So went back at it one more time, and you know, looked at trying to revise and refine the business. So we learned each time, which was good, and we learned. But I think one of the takeaways, and I'm going to stop then for a moment. One of the takeaways is it does, to your point, Bobby, it does take time. It's not like selling a house. It takes time and preparation, and it is a process for sure. And there is definitely housekeeping that needs to occur. And the reason I like, you know, speaking to business owners who are like me is because I'd like to think that I could help them cut through some of that garbage that I went through in my failed attempts and really come up with a plan. And that's ultimately what Woodbridge helped me do. I'm on a roll. I'm going to stop and see if they're, you know, got some questions. So.
Yeah, I mean, was there something in particular about Woodbridge that made you feel like this time would be different?
Yeah, absolutely. I mean, it was another 5 years. It sort of happened in 5-year intervals. I had tried a couple times to sell it myself, but I couldn't play good cop, bad cop in negotiations because I knew I was going to have to work with these people. So I couldn't get the most value. And I realized, you know, the deals that we were talking weren't great. So, you know, passed on those opportunities. And again, it was 2020, beginning of 2020, before anybody knew a pandemic was, you know, in our future. And my business partner and I just got talking about the fact that our career runways were getting shorter, you know, getting older, and our kids didn't want to get in the business. And so we started thinking, you know, what are the options? We've tried now 2 times formally and 2 more times, you know, individually to try to sell this thing with no luck. You know, we've got this business that we think we're sitting on a gold mine. We just think this thing is so unique and really built to be big, and we just can't get it through that glass ceiling. And so, you know, do we try one more time to sell it, or do we do what we were thinking as an alternative, an ESOP, sell it to our loyal employees? And we finally decided, you know, hey, we're the ones who've taken the risk all these years. Our families have been along for the ride. We should take one more try at going to market with this thing. So we went back to the process of interviewing banks. We brought back the 2 that we dealt with the first 2 times. By the way, they were going to charge us again, but we, it was okay. We knew them. We brought in a number of others. And then I had been getting emails from Woodbridge for years, and I downloaded a couple of ebooks. It was really nothing more formal than just responding to marketing materials. I'd liked what I'd read, and I'm from Connecticut, and I'd heard of Woodbridge, Connecticut, and I thought, well, maybe. And so I had the additional good fortune of having a nephew who worked on Wall Street, and in fact worked for the Carlyle Group. So he was very experienced. And while I knew Carlyle was not going to be looking at our company because we were too small, I did have the opportunity to capitalize on his experience and his insights. And he actually helped and was part of our interview process with our candidates, our M&A advisors that we were evaluating. And we ultimately, thought, I will say the thing that I really liked about Woodbridge was they talked about the time killing deals, which I clearly experienced. They also approached this like I approached sales when I was selling to prospects, and that is, it's a numbers game. The more people you touch, the more chance you have to potentially sell. And they were talking that. They were also talking about a process and a cadence that they executed. And I'm always been very process driven. I'm a Giants fan, but I always respected Bill Belichick because of his process. Turns out, I guess it was Brady after all. But I did really admire the process. And so with my nephew, I said, what do you think of these guys? He goes, hey, I've never heard of them before, but that's not surprising because they're lower middle market, and we're not. But he said, I got to tell you, I'm impressed with what I've heard too. And so we decided to sign on the dotted line, and ultimately, I can talk to the experience I had. It was phenomenal, and to the point, it was absolutely transformational for me. It ended up being the best vendor experience of my career, and I can be really, really tough on vendors.
And Ross, you guys were so buttoned up. I mean, it made it for a very nice, efficient process. In fact, I've got the numbers here. We're 164 engagement days from the time that you signed to the time that your money was wired to your account. 126 days in market, and 70 days from the time the LOI was signed to the time that the deal closed. So
yeah, and it was phenomenal. I mean, it was Woodbridge driving the process along and playing bad cop, and allowing me to be, hey guys, I want to work with you, but my closer, my Woodbridge is, they have certain expectations, and they drew lines in the sand. I mean, I'll tell you one anecdote. About 30 days before what had been defined as the close date in the LOI, our buyer realized and contacted our closer and said, hey, we just realized that the close date is the Friday of Thanksgiving week. We're willing to work that day. I'm sure Woodbridge is willing to work today, but all the peripherals, the accountants, the lawyers, they're probably not going to work. Could we have another week? Could we close the following Friday? And again, I can be a type personality, but I was like, yeah, I'm thinking, yeah, guess we could do that. They've been really pretty straightforward so far. Our closer said, no, we're not letting them off that hook that easy. We'll extend it, but they've got to draft us a formal apology note in writing and ask for and define a new close date and time. And they did, and wrote that letter, and we closed Friday morning, December 4th, 2020 at 8:30 in the morning. I was sitting in my car outside my dentist's office, and the close date and time was supposed to be the 4th at noon. So they beat that timeline. And that was Woodbridge. I mean, they were driving them, and that was key.
I mean, it's such a staid industry. You have a lot of these institutions that are, been around forever, and they don't feel that sense of urgency. In fact, it is often to the buyer's benefit to drag things out, wait for a bad time in the business, and retrade.
Absolutely. Well, after we sold the business, I ended up having the additional experience of being the CEO of a company now that was acquiring, and I oversaw 5 acquisitions. And so I sat on the buyer's side of the table, and it was exactly that, Jacob. It was, hey, can we draw this thing out a little bit more? Maybe there's an inflection point, while we're also shopping for maybe a better deal with a different, seller. There's gamesmanship.
We got a couple of questions. The one I wanted to ask you, which is one that I have, is, you say time kills most deals. The other thing that kills most deals is the inability for the business owner to keep their eye on the ball.
Oh
And they
man.
fall in love with the transaction process. And you went through that 3 times. Not only did you go through that 3 times, but then you had the fortitude to stay 2 additional years after you made the deal.
Yeah.
What kept you focused?
In fact, I didn't stay focused the first 2 times, and I paid the price. I came out of both of those processes with my tail between my legs and work to do in a hurry on the business, because exactly to your point, you get, your mind goes to, I'm done. This thing is going to get done. You get the LOI, and again, as a newbie, I thought an LOI that basically meant the deal's done. I due diligence, what's due diligence? And, I did take my eye off the ball, and it was particularly tough the first time, and it had real impact on our business. So we weren't running the risk of going out of business, but we definitely took a downturn. I mean, I bet that, again, harkening back 20 plus years, I bet we took a 20% hit that year, year over year. And we did it again, fool me once, but the second time we did it again. We thought, okay, this time we're way into diligence. It's 5 months. We've met these people. They've come, they've done on-site evaluations. This thing it's gonna get done. And I mean, as I said, morning of the close, it blows up. I took my eye off the ball that time too, not as dramatically, and it didn't hurt as much from a financial standpoint, but it hurt more emotionally that time. And so the third time, when we decided to go through this with Woodbridge, I was emphatic with Woodbridge about the fact that I cannot take my eye off the ball, because if I don't sell this thing this time, which is clearly very possible since I've already failed so many times, I got to have a business that's still viable and growing, that either I can sell to my employees, or I can, figure out a way to have it run itself more, and I can, take more time to myself. And so I was absolutely emphatic with Woodbridge about that. And they pledged that, no, we've got a team that works on this. And that was the thing with the investment bank, the small ones, the team is small, and they got a analyst and, and the closer, and that's it. I showed up for the kickoff meeting with Woodbridge, which was Zoom at the time, and there were 25 people on the call. I had a book writing team that was 6, led by one particular person. I mean, they took the whole thing and made it a kind of a wake me when you're finished. I'm being a little facetious. I mean, clearly,
The team approach is so important.
it was huge. It was huge. It was huge. It was absolutely the epitome of what we needed, and it was the absolute contrast to what I'd gone through the other times.
Ross, I have a question. The deal that you ended up taking with the help of Woodbridge, how did you know it was the right deal? What was the defining moment?
Well, we got 34 bids, which is in contrast to 2 the first time, 2 the second time. So that was, clearly we had a lot more options. We took the second highest offer in terms of financial outcome, but the terms were absolutely light years better than the terms of the higher priced. I mean, first of all, the higher bid was a small group that really was going to have to go out and secure funding, so they didn't have the money. So that was a big thing. And my nephew, he said, hey, it's not just about the price, it's about likelihood of closing. And so the second place team clearly had the assets, the resources to do the deal. Woodbridge put together a grid that basically outlined a little synopsis of each investor and kind of what the offer was, what the terms were going to be, what the financial package looked like, and what the company's vision for our acquired company was. And everything about the package that our buyer put together just really checked all the boxes. And I will say this, the first day that I looked at the first pass on the bids, and I think there were 11 the first day we were looking at them, I knew right away they jumped off the page at me, jumped off the page. I mean, a lot of things. I mean, one, the money was good. The terms were excellent. The terms on the deal that I got to the night before, when I look back at it, I'm so lucky that it didn't close. It was going to be 50% cash, 50% earnout. Having now sat on the side of a buyer, who, earnouts, there's, they get a little squirrely, and so ours was,
Deal
sorry?
independent of one another, or did you guys pull in a best and final? What was what was the thought process behind actually, dealing with the bids as they came in?
In terms of, well, could you clarify for me what exactly you're asking?
Yeah, no, did you deal with each bid independently and then judge them upon their own rights, or did you go back and say, hey, listen, best and final, and let's aggregate everything and then determine
Jacob, you
from?
want to take that?
Yeah, I mean, we would rarely disclose the exact terms, but we definitely
Yeah, no,
competitive.
just from a sense of
Sure, right, yeah, exactly. So I'm not sure about the specifics in this case, but we often and always aim to play off one another and
Yeah,
say,
and our deal did get revised and refined upwards based on the bids that we had gotten. It didn't change dramatically, but some of the terms did. I mean, as an example, we took more cash at close and a little less equity. The terms of our employment contracts, those kinds of things. So so we did we did have leverage, and that, I will say, is the beauty is that Woodbridge also was really good about making sure that they kept the losers, if you will, in the bidding on the hook, and basically said, because everybody knows these deals aren't guaranteed to get done. And they were very, very explicit with the, losing bidders. Look, we want to get this deal done, and we feel good about it, but, we're going to be back in touch if this does not get done. And our buyer absolutely knew that. And Woodbridge worked that chip hard. And
great to have a bench to pull from, right?
yeah, huge. And I will say too, the beauty of that was, for the first time in all the processes that I had gone through, I actually felt like I was in control. The first times, I don't know if it was because the boutique firms have these relationships and they got to go back to these people over and over and over again. But the bidders in those cases would say, jump, and our bank would say, okay, guys, they just told us to jump this high, start
yeah.
jumping.
I mean,
And Woodbridge didn't do that. We didn't have to do that.
I mean, especially the industry specialists, these guys, their relationships are primarily with the buyers, and they have to keep those relationships alive and strong, or else that's their lifeblood. Whereas we actually have separated out what we call the marketing associate role and the closer role. So we have the marketing associates that go out and solicit for bids. They're friends with the buyers. They know all the buyers. They know what people are looking at lately. They can answer all their questions and be nice. And then we have the closers, and we actually play a video that I've recorded at the beginning after the LOI is signed, saying, you won this in the auction. We can easily go find another buyer, so you have to behave. And if we're ever the source of the delay, we'll be honest, we'll be open, transparent. We expect the same in return. And that really does keep everyone honest. Again, a lot of these buyers are not used to having someone drive a timeline and have that sense of urgency. And it is a little bit of a shock to the system, and it does require that high-handed service maybe, but it does result in better outcomes for sellers.
Yeah, it definitely did for us. I mean, I felt like Woodbridge had my back. And again, I felt it acutely because I had been burned big, especially that second time. Where diligence kept getting pushed and pushed and pushed. Oh, we just need this. We just, next Tuesday. Oh, we can't do it Tuesday because of, this guy's traveling. So we're going to push it the week after. And these little things end up amounting to huge delays. And, there's a lot of time for the buyer to rethink, to reassess. And, it's kind of like, now or never. And that was my feeling. And I will say that I did go into this, prepared to, for the idea that, maybe this isn't going to work, but I'm going to damn well play it on my terms. And Woodbridge, again, gave me the confidence to feel like I could do that because I had these fallback opportunities, these other bidders, if not.
Yeah, and one of the intentions of a lot of these acquirers are to beat you down, to actually beat.
Yes.
That is their process. Let's beat them down, try to get them at the closing table or near to the closing table, most people can.
Interesting you say that too, because when we went through our bid, we had 34 bids, and Woodbridge said this. They said you probably won't have ever heard of most of these bidders. Of the 34, I'd heard of 2, and the 2 were 2 that had been flirting with us that I brought to Woodbridge and said, hey, why don't we include them in the process? Otherwise, I had never heard of any of these groups. We ended up meeting with one of the 2 that I knew. It was a public company. And we did it, even though we knew that their bid was not competitive. We did it just, I wanted to see kind of like, maybe they have this grand vision. They're a player in the market. Maybe they've got a huge future vision for us. And so, let's at least talk to them. We get on the call with them, and to your point, these people that you suspect are going to be these great strategic buyers, oh my gosh, they were the worst. They were obnoxious. They, were the greatest, and I'm thinking your offer stinks. You're obnoxious. I knew in 5 minutes there was no way I could or would ever do a deal with these people. And again, I had options.
Yeah, I actually have a question for you too, Ross. Was there like a specific, I guess, driving force that you had originally, like on the initial 2 sales that you wanted to do? And then also, was there like a specific factor, I guess, through, Woodbridge when you were going through those deals where you're like, yeah, this is it, and this is why I want to do it?
Well, I will say that, again, I always wanted our business to become something special. I will say the first 2 times I was pretty, honestly, I was probably pretty unsophisticated about the whole thing, even going through it with Woodbridge, despite having, gone through the process before. I have since become much more, much more understanding of all the dynamics and all the options that can play into buying and selling businesses. I basically thought, you can sell your business or you own your business, that there's no, chance to, sell your business, but keep an equity stake in it and potentially get a second bite of the apple. And so when I was trying to sell it the first couple of times, the internet was percolating. I was reading articles about companies losing tens of millions of dollars being sold for $100 million. So honestly, I was very mercenary. I was thinking, oh, I'm sitting on a lottery ticket here. And the first reality check was, when they look at due diligence and say, you got a nice little business here, it's kind of cool, but you're making about $5 a year, so no. And so I realized right then, we're not selling this thing with low earnings and big ticket sale at the end. Second time around, I was a lot more measured in my expectations, and so we were looking at it, sell it, and then, again, grow it with the help of this firm and in theory, get another bite of the apple. But, now having sat on the buyer side, I know how squirrely that earnout can be. And so the third time, I never thought, and we were very, very fortunate, as you'll say to your investors, past performance is no guarantee of future results. I was very, very fortunate in that I'd never, ever expected that a cash and equity deal was possible. I absolutely expected that there was going to be an earnout. And Woodbridge was able to negotiate for me a deal that was originally the offer was 80% cash, 20% equity left in the company. I wanted more cash because I'm an old fart. And so I took 90%, but I did still want to keep, my finger in it. And so we left 10%. I ultimately ended up buying more equity after we started rolling up some of these other companies. So I was very, very fortunate. And again, you're starting to get a sense of why I'm so enthusiastic about Woodbridge and why I, had just an incredible experience.
Guys, we have a question from one of the attendees, and I'm gonna kind of paraphrase it a little bit. And this is something that I think there's a couple different ways to answer it, but a lot of business owners can sometimes view themselves as the skeletal structure or lifeblood and muscle tissue of a business, and there's sometimes a fear of what's going to happen to it when I leave it. Does the business lose value? Is it my key importance? Am I never going to be able to really exit? I don't know if you guys have a couple experiences that you can kind of just address where business owners feel like they are very, very much tied to the overall value of the business. how that plays out for trying to get a transaction done, or just concerns or any things that you've seen that, would kind of help with that.
It's a great question because it's something that does come up a lot. And, frankly, it depends on what your goal is. It's always harder to sell a company if it all revolves around one person and one person's relationships, one person's special set of skills. But, if you're aiming to find a partner who's going to, buy a majority stake and you're going to stay on in a major capacity and work with that firm, maybe, a buyer who's going to buy the company as a platform, as Ross experienced, and gobble up some other companies and build it that way. That's something that certainly having that valuable expertise is going to be helpful. But again, for the majority of the time, and what we teach at our management meeting training, when we get new clients in, we have this full day seminar going through some of these points. You're selling your company. You really want to take that, a step back and show how the company can run without you. A lot of the times people's egos will get in the way, that it will become an impediment to say, I'm so important, I'm doing this, I'm doing that. When you really want to be showing, the next generation who else is in the company, who's running things, to the degree that you're feeling comfortable disclosing that to those people, having them involved in the management meetings. Some of our smoothest transactions are the ones where the owner is hardly ever there. Throughout the transaction, they've taken a back seat and really let the people who are going to be running the company run the transaction.
And it's a really good point. It's a lot of what we, when we're talking with clients, it's the big thing is, how do you extract yourself from the equation and have a business that runs itself? Because when you start to think about wanting to sell your business, your personality cannot be tied to that, or else the value of it is going to be tied to your personality. So how do you carve away that?
We were accused the first couple of times. I remember the expression of being a lifestyle business, because we were kind of the point people, and my business partner ran the ops side, I ran the sales and marketing side, and we were really key to the business success. And so that was something we became aware of, and that's where I go back to, you really need to start doing housekeeping in advance of actually thinking about the sale, because these are exactly the things that you need to be aware of. It doesn't mean that you have to say, okay, I want to sell it and I want to be done, but you should go into the process with an understanding of what it is you do want. Do you want to stick around for a couple of years, or do you want to drop the mic and walk away? That will impact what kind of deal you're able to get and what the realities are for you. Do you want to, preserve your employees? That's something that we hear a lot, Jacob, in our calls with prospective, company owners is, oh, I'm really concerned about my employees. Are they going to get, if it's a private equity, are they going to cut everybody? And, my response is, based on my experience and what I've seen, and I think it's a pretty accurate snapshot, is private equity acquisitions in the lower middle market, there's nothing to cut. The companies like ours are lean and mean by design. Those acquirers, they want you to grow the thing. And in fact, what we did, we always prided ourselves in having one piece of equipment and one person short. Our private equity buyer wanted us to hire people because they wanted us to close out work so we could recognize revenue faster. So our thing was hiring people, not getting rid of them. They also they underwrote the deals to keep our long-term key employees and gave them options and those kinds of things. And that was on their dime, not on mine.
Most of the people that we see that take those extensions also go into it with rose-colored glasses, thinking like, I'm going to stay on for another year, it's going to be great, and then they realize, wait, I'm not making the call, I'm not calling the shots anymore.
Yeah,
it's very deflating. How do you navigate those conversations when people are saying, you know what, I could stay on for another year or two? Do you give them any sort of an anecdote to say, hey, here's a process that you should go through to really think if this is going to be the right fit for you? Or how does that work when you have a client who wants to stick around?
I mean, based on my experience, and not as extensive as Jacob's, but based on what I saw, what, you know, we were a platform. So I remained CEO, and we were bringing on companies that were led by founders. And I will say that there were different reactions from different people. Some of the founders, you know, said that they wanted to be involved, and you know, within 3 months they, you know, were sitting on a beach somewhere, and it was okay. That was okay. You know, we had expected they were going to be involved, but we didn't need them to be involved because they had prepared their businesses. There were other people who had grown businesses, founded and grown businesses, who it became very challenging for them not to be calling the strategic shots. So you have to go into it with that understanding. I will say that I reached an inflection point at the 5th acquisition where this company is becoming something different than what I strategically wanted it to be. I'm still on the board. I have an investment in it. I want it to be successful, but it's not my baby anymore. And our buyer, you know, they own it. I gotta live with that.
Yeah. Yeah. I mean, I would say, Bobby, you're on mute, but to quickly give my 2 cents as well here, I think the most important thing, honesty, transparency, openness, dialogue, having it early, having it frequently. And then once you do have a buyer that's picked, an LOI is signed, to have those conversations right off the bat. What do you want to do? Where those conversations get kicked to the end, that's when, you know, there's a mad scramble to figure things out. And that's the kind of angst that causes the deal to break down in the last minute.
Yeah, so you know, this is probably something that, you know, we're going to be doing a business symposium, multi-part, going into the fall, probably into the spring, and we're going to have that almost revolving. And the Woodbridge guys are going to be part of that, and I think that this is a really good topic for us to extend upon, because there are a different number of variables in terms of ways that deals can be crafted and structured, that as a seller, you're going to want to see, okay, what are things that kind of tick the boxes that I'm interested about, and what are the things that I definitely do not want incorporated into the deal. So, you know, I'm looking forward to expanding that. It's probably going to be a, you know, October, November timeframe, and then, you know, probably about a May timeframe on the second round. But you guys are great. You know, I love what you're doing. If you need to reach out to Woodbridge, we're going to put all the information into the notes for the webinar. Really glad that you guys spent the time. I know we went a little bit over today, but I think it was all for good reason, and some really good information. So any parting words?
You know, I mean, again, congratulations on the businesses you've built. You know, you can get the deals done, but it does take work.
Yeah.
Amen. All right, guys.
Thanks for having us.
That's a wrap for this month, rather. See you next month, and keep a lookout for the notes below and the business symposium that we're going to be running later in the fall. So thanks, guys.
Thanks, everyone.
Thanks, everyone.
Good job, everyone. Appreciate you.
Be cool out there.